Let's take a look at how the markets are digesting, particularly on the tech side, what's going on. And we've got some signs as well of what's going on the retail front. Abercrombie & Fitch adding to Best Buy, the latest retailer, saying, you know what, things are not going so boffo. Our customers are not inclined to spend as much, if spend at all. And they are giving guidance that isn't exactly cheerful. Let's get the read on all of this from Dave Maney and Eddie Gabor, their respective read on this. So today, to you first. It's interesting. Technology has problems once again, but we've talked the backdrop for this, how difficult it is for the markets to follow an update with another update. What do you make of that?
I'm not sure. This one feels a little to me like a little idiosyncratic in that, you know, Snap is the fashion company of technology stocks. And I think it's very hard to draw massive conclusions. The stock's down 40% today. And I think it's hard to draw huge conclusions out of that because it seems to be one of those that's a little bit off center. Having said that, you know, it's very clear that this is a time of tumult and upset. And therefore, you know, the market's on tenterhooks, and anything that shows up as bad news, even if it may not be related to core trends in the economy, is going to be taken as very bad news, and you're going to get 40% of your block knocked off.
Yeah, I think you're right about that. Best Buy probably indicates that. If you think that so much of this stuff, technology-related items, technology stocks in general, having a tough time of it, Eddie, what do you tell investors about this once incredibly hot sector that seems to be like catching a falling knife right now? You never know where the bottom is.
We have been staying away from tech. We told clients back in the fourth quarter of last year, we started to get bearish, and we started getting out of technology November, December, January. We have not bought one of these dips. The bottom line is, that's correct. The bottom line is, and we've been very consistent with this message, this economy is decelerating at a historic rate. And in our opinion, the last place you want to be is growth stocks. Everyone continues to try to find the bottom, but things can get oversold just like they get overbought in bull markets. So it works the other direction when you're heading into a bear market. So if you think we're going into a recession, you should expect these securities to continue to go down, in our opinion, because the bottom line is we haven't seen the worst of the economic data yet. The second quarter earnings, these companies are going to be revising their earnings for second quarter. It's going to continue to be very weak because the consumer does not have discretionary income to spend like they did a year ago when you look at the inflationary rate. So this is one of the worst setups you can have for technology from a historical perspective.
I just wonder how bad it is, and with all deference to you, Eddie, and Dave, I'll get your take on this. When J.P. Morgan is saying that consumers are in generally good financial health, that doesn't make, you know, Jamie Dimon Nostradamus. I didn't want to take it that way. But certainly a lot better shape than we were in the last inflationary spiral that we saw back in the 1970s with Jimmy Carter. So the backdrop for the economy is very different. And I think that's what J.P. Morgan and some of these others are getting at, that we're not repeating that. Do you agree with that, Dave?
I could not agree with that more.
Dave first.
I spent a lot of time this weekend talking about exactly that subject. And, there's this kind of notion, you know, street veterans tend to sort of be, well, this happened before, and this reminds me of this thing that happened before. Can you remember when the last time the economy got shut down and the entire, you know, this is like we had the Stuxnet of the economy, right? That virus we shot into to bust up those centrifuges in Iran, you know, 12 years ago. We had a spinning, delicately balanced economy, and we shut it down. And for us to believe that we know what the patterns will look like emerging from that economy and that this signal will mean that thing, we just don't. Yeah. And so I laugh a little bit at anybody who thinks that some previous playbook will tell us what this one looks like, whether on inflation or markets or anything else related to the economy.
You know, Eddie, the old market line that the cure for high prices are high prices. In other words, you get to a point where they get so high that it slows things down. And I'm not examining and obsessing over the performance of the bond market just today or over the last couple of days, where we're down now to around, 2.73% on a 10-year. Is that telegraphing the very slowdown that these higher prices are bringing us? And could that mitigate the damage from all this? Of course, the flip side of that is, you got a slowdown, possibly a recession. That's hardly, saving grace. But what do you make of that?
So I think the bond market has had this thing right for months. And right now, I think the 10-year has probably topped out this year. It doesn't mean it's not going to go back over 3%, but I think we've seen the highs in the 10-year because the bond market sees a slowdown. But here's the problem, Neil. The Fed is going to be tightening rates at the worst possible time and raising rates. I believe if they didn't do anything, that the slowdown is already here and you would see things disinflate and we could have a softer landing than what we're going to have economically. But in my opinion, they're going to be tightening into this massive slowdown, possibly another 100 basis points or more. I don't know how we can escape that without a lot more losses and carnage economically. And so this is why we've been so bearish in regards to this economic backdrop and how it's just getting much, much worse. The retailers have really said it all when you look at the numbers on the activity there and the margin compression from wage growth and the cost of goods. That's not going to solve itself because of rate hikes. So it's going to be a very tough time period right now for businesses and consumers.
All right, guys, I want to pick your brain a little bit more later on about how all of this factors out going into the busy summer season, the travel season, everything else, and what consumers do. But thank you very much in the meantime. So could all this be as simple as supply and demand? And the demand ebbs if the prices get high enough, and all of a sudden we're in a slowdown or worse. Dave Maney back with us, the Expert Press CEO, Eddie Gabor, the Key Advisors Group co-owner. Eddie, Eddie, would you begin with you on this notion that maybe we're looking for sinister foils where there are none? What do you think?
Look, this process, and it's very painful what we're going through right now, has to reset on its own. The Fed can come in and try to do what they're going to do. The federal government can try to do what they're going to do. But the problem is the damage is already done, and the consumer is already struggling. And I think you're going to really see consumption really start to come down. We're already seeing that at the consumer level, but it's going to start to accelerate as these gas prices stay as high as they are. So the market's just going to have to reset on its own. It's going to be painful. That's why you're seeing the market do what it's doing. That's why you're seeing earnings do what they're doing. But look, it's been a while since we've lived through something like this, and it's not going to fix itself overnight.
I'm just wondering what consumers might be telling us, and we got into a little earlier, Dave, about the kind of news we're getting out of Best Buy where sales are cooling, and it's warning that that will likely continue. We're getting the same out of Abercrombie & Fitch as we're Walmart and Target. Not everybody, but most of the retailers, and maybe we'll find out more from Nordstrom after the closing bell. Is the consumer retrenching?
I think the consumer is reeling. This is a moment in time. This is how worried we should be. We're asking Obama administration officials to explain how capitalism works. Like, that's how bad the environment has become. The prices are the signaling and adjustment mechanism of a capitalist economy. And those prices signal to consumers when things have gotten more dear and may need to be cut back on, and when they're more abundant and can be had and enjoyed in greater number. And as Eddie says, that's what will fix the situation. It's broken because of government distortions, i.e. lockdowns in response to COVID. And for these Democrats to say the answer is more distortions is lunacy.
Now, Eddie, I know you've been eschewing stocks, but we do notice the area that's been least damaged are dividend-paying companies that at least give you something for the risk of owning the stock. And I'm wondering how you play that, or do you recommend that?
So right now, in our tactical strategy, which we play on our short-term market thesis, the only securities exposure on the equity side that we have right now are utilities. We feel like utilities are going to provide the best volatility-adjusted return for clients, and we've exited out of every other sector right now. So we think we're going to be hitting into the roughest patch here over the next couple of months from a volatility standpoint. I expect to see the VIX in the 40s this summer. when the VIX is in the 40s, there's a very few places you can go for stability. So from an equity style standpoint, we're sticking with the utility side right now. We think that's the best place to be from a volatility standpoint.
All right, we'll watch closely. We're talking about the fear index, which, of course, has not gotten that high since, of course, around the time of the meltdown here. So if that were to revisit, that could be problematic. Gentlemen, I want to thank you both very, very much.